Imagine paying $300 toward your credit card and watching the balance fall by only about $3. You begin with an $8,000 balance at about 22% interest. In a simplified month, interest adds roughly $147, while another $150 of ordinary expenses goes onto the card. After your payment, the balance is still about $7,997. The payment did not disappear. It fought interest and new borrowing at the same time. Actual card interest is usually calculated from daily balances, so results vary. But the basic problem is simple. Interest and new charges can consume almost all of a payment. This is general financial education, not individualized financial, legal, or tax advice. Start with your last 2 or 3 statements. Find the interest charged, new purchases, fees, payment made, and ending balance. Then ask, after interest and new charges, how much of my payment actually reduced the debt? Your statement should estimate repayment time using only minimum payments and no new purchases. The minimum is a required floor, not an efficient payoff target. Before choosing a payoff method, identify your situation. If you are current on every account and can cover essential expenses, you can build a self-directed plan. If you still use cards for necessities, you have a monthly cash flow gap. A payoff plan will remain unstable until that gap shrinks. If you cannot afford every minimum, protect essential needs and contact each issuer early. Explain what changed and what you can afford. Hardship options may be available, but none is guaranteed. If an account is seriously delinquent, in collections, or connected to a lawsuit, professional guidance may be more appropriate than an ordinary payoff strategy. For current accounts, make at least the minimum on every card while directing extra money toward one target. Next, review what is still being charged. Move routine purchases and recurring bills into your current budget where possible. Do not reduce every debt problem to coffee or subscriptions. Sometimes income simply does not cover essential costs. If necessary expenses already exceed income by $200, adding a $300 payment makes the plan $500 short. Neither the debt avalanche nor the debt snowball works, while new borrowing continues at the same pace. You should also preserve an appropriate starter emergency buffer. Sending every available dollar to the card may backfire if the next tire, copay, or repair must be charged again. There is no universal starter amount. It depends on your household. Keep essential bills and affordable minimums current, maintain a modest starter buffer, and then direct most available cash toward high-cost card debt. For a detailed method, watch How to Build an Emergency Fund When Money is Tight. Next, build a debt map. For every card, record the balance, annual percentage rate, minimum payment, due date, interest charge, promotional rate expiration date, and new purchases. This shows which debt is most expensive and what needs attention first. Now calculate a payment that can survive a normal month. Begin with average take-home income, subtract essential expenses, minimum payments, irregular necessities, and a checking cushion. What remains is your preliminary extra payment capacity. Make that number slightly conservative. If the calculation suggests $300 but leaves no room for changing utility bills or routine car maintenance, $225 may be the stronger starting payment. A payment that works only during a perfect month is not a working payment. Review it after 30 days. Adjust it if it causes overdrafts, missed essentials, or renewed card use. The goal is a meaningful payment you can repeat. Now choose between the debt avalanche and debt snowball. With the avalanche, make every minimum and direct all extra money toward the highest rate card. This usually minimizes total interest. With the snowball, make every minimum and target the smallest balance. This may create an earlier win, but it can cost more when higher rate debt remains. Consider Emma. One card has a $1,200 balance at 18%, another has a $5,000 balance at 29%. Her minimums total $190, and she can reliably pay $450 per month. That leaves $260 extra. With Avalanche, the extra goes to the 29% card. With Snowball, it goes to the $1,200 balance. In a simplified model with no new charges or fees, both finish in about 17 months. Avalanche costs roughly $150 less, while Snowball completes its first balance about 10 months sooner. That is the trade-off. Avalanche is the mathematical default when minimizing interest is the priority. Snowball can be reasonable when an early win improves follow-through. Whichever method you choose, focus the extra payment on one target. When that balance reaches zero, keep your total monthly debt payment the same. Move the old minimum and extra amount to the next target before the freed money disappears into ordinary spending. Lower cost options may help, but evaluate them carefully. First, call your issuer and ask about hardship options, a lower rate, fee relief, or a different due date. A balance transfer may help, but include the fee, expiration date, later rate, and payment required to finish on time. 0% does not always mean free. A consolidation loan may help, but a smaller payment can come from a longer term and higher total cost. Compare the full cost. Be cautious with home equity. Turning unsecured car debt into debt secured by your home can put the home at risk. A new product changes where the debt sits. It does not fix what keeps rebuilding it. Seek help early when minimums are unaffordable, several accounts are delinquent, collection pressure is rising, or necessities require new debt every month. A reputable nonprofit credit counselor may review your situation and explain a debt management plan. Ask about services, fees, and plan requirements. Avoid companies that guarantee elimination, discourage creditor communication, or promote missed payments without explaining the risks. Stopping payments can add costs, damage credit, increase collections, and create lawsuit risk. Here's your 30-day action plan. Gather every statement. Build your debt map. Measure how much interest and new spending replaced your payments. Protect essential bills and affordable minimums. Decide whether you need a starter buffer. Choose one target card and one extra payment that can survive an ordinary month. Schedule it after the supporting income arrives. After 30 days, ask, did the balance fall as expected, or did the payment force renewed card use? Adjust it based on the answer. If minimums are unaffordable, contact the issuers now rather than waiting. For the broader decision about saving, repaying debt, and investing, watch our video called Save, Pay Off Debt, or Invest, the right order for your money. Your balance barely moves when interest and new charges consume most of the payment. Stabilize the account, stop replacing the debt where possible, preserve a starter buffer, map every card, choose a payment that survives a normal month, focus extra money on one target, and roll each completed payment forward. Evaluate transfers and consolidation by total cost, not only the advertised rate or monthly payment. When minimums are no longer affordable, seek legitimate help early. Your next action is simple. Open your latest credit card statement and calculate how much of your last payment actually reduced the balance. That number tells you what must change first. Subscribe to Wealth for Legacy for practical financial education designed to help you build wealth, protect it, and pass opportunity forward. Thank you for watching. Keep building your legacy.